Good afternoon, everyone, and welcome to the SIA Wealth True Tactical monthly webinar for December 2021. My name is Colin Szynski, Chief Market Strategist, and I'll be the host and presenting today. If we're going to keep this relatively short and keeping in tune with the shortest day of the year, so I will, if anyone does have any questions afterwards, please send this, put it in the chat or send us an email at siateam@siawm.com, and someone will get back to you post haste and forthwith. So let's just leap right into it here. It's been quite a few weeks here for the markets. We've seen the markets start to rebound today after several days of being under pressure. There's been a lot of change, a lot of uncertainty out there, and I think that and a lot of choppiness. So we'll get right into everybody's questions today. I'm going to focus on market insights and answer some of the questions that we've received from our advisor clients, as well as some of the questions that I've received in the media as well from doing interviews. So we'll begin with the question and answer session. First question right off the bat, are we going to get a Santa Claus rally this year? What happened? Do we usually get one by now, and could we still see one? Today's market action says it's still a possibility out there. This slide here is our usual seasonal slide, which I've updated as to up to yesterday's close. And what we can see is that historically, markets tend to be strong in the last quarter of the year. Usually the middle of the year is when we see the choppiness, and then the end of the year is often fairly strong. But this year has been quite different. We had a much stronger than usual October, followed by a much weaker than usual November. It's rare that we actually get a November market decline, and that of course was because towards the end of the month the COVID Omicron virus popped up, and then all of a sudden all of the reopening plays and the travel plays and energy prices and a whole bunch of things that would be sensitive to new restrictions all got hammered. And that has still been the case into December, although interestingly enough, this month has been a little more mixed, and at the end of the day so far, we're basically running about average for the month of December, slightly less, but I was slightly less as of yesterday's close, but if we continue to see the markets bounce back today, we could be right on that average. So, and now we're heading into the what's historically been two of the quieter weeks of the year, certainly for news and oftentimes for market as well. There was one year, however, where we saw a severe sell-off in the market in December, and that was 2018. So I created a couple of slides to compare, well, what does 2021 look like versus 2018? In 2018, we had a major market correction, and then in the middle of December, the Fed came in as being more hawkish than the market was expecting. And why I thought it was an interesting comparison, because this is the first time since that the Fed has gone significantly hawkish in December. We've also seen other central banks going hawkish as well. The Bank of England raised interest rates. The European Central Bank announced tapering. The Fed, of course, announced tapering and moved up their timetable for interest rate hikes. But so far, we can see that in 2018, which is the blue line, the market started to sell off in September, October, and then when the Fed came hawkish in December, we had a big washout. And that was the sell down to the Christmas Eve sell-off and the Boxing Day rebound in the United States. And then after that, markets kept rebounding and didn't look back. This time around, we had strength in October instead of weakness. And really, since then, we've just been kind of chopping, spinning our wheels. You can see there was the November pullback and the more recent pullback, but they haven't been anything near the severity that we saw back in 2018 as of yet. This is for the S&P 500, and this is for the Russell 2000 index. Once again, we had strength in October, and that was enough that we saw that kind of unwind. And in the case of the Russell, we're just kind of back to where we were in the summertime, but we haven't had that big drop, that big washout pullback that we had seen in 2018. And we may not. We may end up just testing support here. It's hard to say. I will show a chart on the Russell later with some of the key support and resistance levels. So the next question was, what's going on with the central banks and why are they being such Grinches? A lot of them have accelerated tapering, raised interest rates. Why now? And the very simple reason for why now is because inflation is really getting out of hand. Most of the central banks spent this year trying to say that, oh, it's all commodity based, and oh, inflation is transitory and temporary, and all these other things that have flatly turned out to just be dead wrong. And now they're scrambling to start catching up because they've all gotten themselves behind the curve. And so just as an example here, I'm noting current inflation versus where it was reported back in the summertime. So latest US consumer prices 6.8% was 5.4 in the summer. And let's remember, all the central banks' long-term target is about 2%. That's the Bank of Canada just reiterated that, confirmed that last week, and the others are all kind of around the same. And they might let it run above a little, but they usually don't want it running that far above for very long. Some of the other ones, US producer prices 9.6%, house prices 19.3%. The most important one, average hourly earnings. That's wage inflation. Wage is the stickier one. Yes, commodity prices go up and down, but wages, once they go up, tend to not go back down very quickly. And we'll recall back in the 70s when they brought these things in, it was called wage and price controls because it's both. And that's really important when we're looking at inflation. So a US average hourly earnings most recent was 4.8%. August was more like 4.3%. And we're also seeing higher than, perhaps not quite the same increases in Canada as we saw in the United States, but it's running high enough to encourage the central banks to continue to take action. And if we look more specifically, even around the world, I'll just look at the consumer price numbers, but US 6.8%, Canada 4.7%, European inflation running around 5%. Interestingly enough, China's inflation is lower at 2.3% for consumer prices, and the People's Bank of China this week actually cut interest rates slightly. It was 10 basis points they cut, but markets saw that more as a signal of they're still a little bit concerned about what the impact of Omicron and supply chain disruptions and semiconductor shortages, other such things might have on their economy. So just to note the central banks here, this is one slide that we tend to use, and it's useful for showing where people are in the various camps now. And what we've seen with this is that in terms of actively tapering and hawkish are the Bank of Canada, New Zealand, the Fed in the US, and actually also now the Bank of England and the European Central Bank as well. And the Australians are talking about tapering, and the Bank of Japan is still kind of sitting on their hands and not doing much. There are some central banks that have actually been easing. China was one, and actually Turkey is another one. They're having another economic upheaval, and their central bank has actually had to go the other way. Moving on now to the next part of our next big question of the day is what's going on with retailers. Retailers, a lot of them just got absolutely crushed in November, and they've remained under pressure into December. And the interesting thing I was looking at with this was at the same time I was looking at home builders and lumber, and those areas have been doing really, really well, while retailers have been doing poorly. And so we've seen the headline grabbing sell-offs from the retail sector. And so we're thinking about consumer confidence and consumer spending. So first, I thought I'd bring up some of the numbers for consumer spending. They've been a little bit mixed. US retail sales came in for most recent reports significantly below expectations. The Canadian retail sales, which were actually announced this morning, came in substantially above expectations at 1.6% growth over the previous month. Excluding auto sales, which tend to have larger swings, the numbers are still pretty similar. The US was soft, Canada was extremely strong. What's interesting here, though, looking at the most recent housing starts announcements, the US beat by a small amount. Canada was a huge beat. The Canadian housing starts extremely strong at 301,000 in the last month. So what does that tell us? That tells us that people are spending money, but most importantly, people are spending money on houses, and people are spending money on hard assets from the looks of things. And this chart here that shows the how the markets reacted to retailer earnings. So this is the day returns on the day following the earnings release for all these various retailers. We can see Walmart and Target, mainstream retailers, had moderate declines. The two of the strongest ones, Home Depot and Lowe's. So people were spending money on hard things to fix up their houses, and housing starts say that people are spending money on houses themselves. So hard purchases, durable goods. That's where people have been spending their money. On the other hand, and Macy's, amazingly enough, did really, really well. On the other hand, though, soft goods and non-durables, not so much. In particular, I contrast Bed Bath & Beyond, who is more like, as we know, soft goods for the home, bedding, appliances, picture frames, stuff like that. Their stock got slammed, but but stuff that you would use to fix up your house did well. So it's quite a contrast between Bed Bath & Beyond and Home Depot in particular. But then we also look clothing retailers, Nordstrom and Gap, 20 to 30% losses the day after their earnings, and even Best Buy in Gamestop, both in electronics and video games, 10 to 12% declines. So we can see that certainly the way the market was reacting to all of this, soft lines and electronics and things like that, not so much. But hard purchases on home improvement did extremely well. And they're seeing this also in the retail sector. Just to note for everyone that we did appreciate all the feedback you had on the charts. I have made more of an effort to try and make these a little bit more readable this month, adding in dates and adding in prices. So hopefully this will help everyone to see everything better. The retailer sector had started off the year strong, and it was one of these sectors that had really gotten caught up in the sideways market that persisted between March and October, and then maybe picking up again. And we saw that in November, in fact, the retailers had what turned out to be a false breakout. Things were looking great. It broke out to the upside, then turned around, got slammed, but more importantly, has been slammed again, and now is starting to trend downward. Took out support in around 87.50 and remains under pressure at this time. The home building sector was extremely strong until a couple of days ago. It actually had broken out earlier in December. It's now had a bit of a pullback, but so far this pullback's been contained above previous lows. So far, whereas with the retailers we're seeing a decisive downturn, with the home builders we're seeing a correction within an uptrend. And so that once again is indicative of that we've seen it in the housing starts, we've seen it in the home improvements as well, that people are still spending money on houses, although even here the sector we do get market corrections from time to time. And here's another one, is lumber, in terms of where people are spending their money, and more importantly is in the United States they have home building stocks and not so many forest product stocks. In Canada, we have more forest product stocks and we don't have any home building stocks. So it's a matter of which part does it relate to. So the home builders relate a little more to consumer spending. The lumber and the forest products are more on the raw materials end rather than the finished goods end. Anyways, the price of lumber we had seen in 2020 soared from $250 to almost $1,700 by the middle of this year. Massive summer correction back to $450, but in the last month or so in particular, we've seen the price of lumber explode again to the upside. This is this high demand for home improvement and home building, driving it back up above $1,000. Now, moving from that, the two things that are often tied together, but are in consumer confidence and investor confidence. And so this is where I'm taking a look here at some of the markets where what happens with some of the markets, such as meme stocks and cryptocurrencies, telling us about investor confidence out at the margins. These are the areas where people go when they're feeling good, where people go when they're feeling aggressive, when people are the risk-on areas of the market. And how are they acting, and what is that telling us at the current moment? So starting with Bitcoin, we can see that Bitcoin had a massive rally in 2020, but truth be told, 2021 has been a choppy sideways market. We did have a rebound from the summer into November, but more recently in Bitcoin, we are seeing a pullback. Even though it's a pullback within a range, it's still a sizable pullback all the same. So just keeping an eye there, we are seeing some deterioration in that. I'm looking at Gamestop as the poster child for the meme stocks and the Reddit crowd. This stock started the year down around 13 bucks and exploded to I think the closing high was around 350, and I believe the intraday high was just short of 500. This thing's had some wild swings over the years. This has been the crucible, the big battleground between institutional traders, hedge funds, and individual traders trying to act as a group and use the power of the collective. Anyways, what we're seeing here is that each upswing we've had in GameStop has peaked at a lower high. More recently, it did have a pullback. It did have a spread triple bottom breakdown below 138. It's bounced a little bit. It remains to be seen whether it's in a new upswing or not. It's a little too early to say. But overall, when we did see this market pullback of the last couple of weeks, we have seen the meme stocks also come under pressure. This action in Bitcoin and GameStop is indicative that capital is kind of coming back out of the risk areas and going into some of the more conservative areas of the market. Another traditional area where people move to when they're looking at risk is taking on risk and for potential return is emerging markets. Emerging markets had a massive rally in 2020 up into the beginning of this year, and they've just been steadily under distribution since about February, where we've seen some markets go sideways. Emerging markets have been clearly declining, lower highs, lower lows, broke down again earlier this month. It's on a triple bottom. And so emerging markets at this point, still under distribution. And we contrast this decline in the emerging markets with the Russell 2000, which is, of course, small caps. And in the case of the Russell, we can see it's just totally gone sideways. And the range is about 2100 to about 2350. We actually had, like the retailers, a false breakout in the Russell back in the middle of November. Look, things looked fantastic. And then when people retrenched and reconsidered, boom, right back down again. And now we are seeing that the Russell is still in a downswing within this trading range. It hasn't bounced enough yet to call that off. The interesting thing is that one of the areas that hasn't done much yet is gold. Oftentimes gold tends to do well during times of high inflation. Gold has historically done well in times of market fear and concern. Yet we did see gold try and break out in November, but so far in December, it hasn't done much. And what this indicates to me at this point in time is, yes, investors have retrenched. Yes, investors have become more cautious, but investors aren't panicking either. This really does feel more like a downswing within a sideways range, or a correction within a longer term uptrend, those kind of things. Not a full-blown downturn, not a full-blown panic as of yet. And so going back to my first question, there is a possibility at some point that Santa Claus could still come around. It could be once, I think that some of this more recent pressure may have been maybe related to tax loss selling in some cases, because we have had a choppy market this year. So it's something to consider anyways overall. But gold has not gone anywhere. One thing we have seen, a couple of things we have seen from our sister company SIA Charts is in some of their rankings in stocks, they have noted that there has been a rotation into some of the more conservative defensive areas in the market. In today, they had published a report earlier today in their daily stock report on CVS Health, as an example, is a U.S. drugstore chain that had struggled and underperformed for years. All of a sudden, has started to show some relative strength. Also, in the SIA Charts asset class rankings, the bond sector, which had been the lowest ranked group, actually moved up a spot and has started to pick up a little bit. So once again, we are seeing in selected places that there has been a move to conservatism. There has been a move to investors being a little bit more cautious here heading into the latter part of December. But at the same time, though, gold is still telling us it's not a panic. at this point in time. Well, we'll move on now to commodity prices. And since our November webinar, commodity prices in general and energy prices in particular seem to have hit a wall. And so the question is the commodity inflation story over or just pausing? And in some ways, it depends on what market you look at. A couple of minutes ago, I showed the price of lumber screaming higher, but energy for oil, for example, has been a different story. This is a 10-year chart on the price of crude oil. And so we had the massive sell-off in 2020 and the big rebound. And so what was interesting was back into November, crude oil actually had broken out to its highest level since 2014. It actually had cleared that 2018 peak. And in 2018, that was when it hit President Trump's pain threshold. Politicians hate rising energy prices because then gasoline prices go up and voters get mad. So when we had that, we were asking the question in November, what would be President Biden's pain threshold? Well, instead of 77.50, it ended up being about 85. But it was the same sort of thing. They were talking about releasing strategic reserves and other such things. And then the crude oil price has been knocked back down into around $70, give or take. So, I mean, we may be moving into kind of a wider 60, 80 kind of range here. It's hard to say. The support and resistance levels are still in a little bit of flux here, but it looks like overall, having moved up, we've now and had a correction, we're now kind of into a pause of consolidation kind of range. I'll just also to highlight on that, I had mentioned the asset class rankings. Something that we also saw today was that in the SIA charts asset class rankings was that commodities, which had been number one for several months now, actually dropped down into second spot, and U.S. equities actually had moved back up. So a little bit of a sign that yes, some of the real strength in commodity prices might be easing off a little bit here. And of course, the longer we go now, we start to get into the point where we start lapping higher prices year over year, and that's a point where we might start to see some of this inflation start to ease anyways, at least on the commodity side. We're seeing this also in copper. As we can see, copper had that screaming run up off the bottom. It since for the last 6 months or so has been in a range between $4 and $4.80, and flatly it's still there. So again, with going back to the inflation story, some of the inflation could be transitory. That's particularly related to commodity prices. One of the reasons why we saw this weakness and pullback in crude oil was when Omicron virus came along, and all of a sudden travel restrictions started to come back, and because of that, people are thinking, well, perhaps the fuel demand may start to come off, and boom, we have a market correction. So and we've now seen commodity prices starting to correct as well. But the most important thing about that is the supply chain problems still aren't going away and haven't gone away, and the wage inflation has not gone away either. And so those are ones that still need to keep an eye on. Transport costs are higher, not just because of fuel, but because of limited availability of being able to access it, whether it's trucks, whether it's trains, whether it's container ships, or what have you. It's not just about the fuel cost, it's also about actually being able to get somebody to provide the service. So because of that, we are seeing that wage inflation has been a little bit stickier of late than perhaps commodity prices. On that note, that concludes the remarks we've prepared for today. As promised, I thought I would try and keep it to about a half an hour or so. We would be more than happy to answer any questions that you might have. Please send them to sales@siawm.com, and we'll be more than happy to get back to you for more urgent questions. And for more general questions, of course, we also keep these in mind, and we do try to address them in our monthly webinars. This is the codes and sales information, of course, for the funds that SIA Wealth sub-advises for BMO Global Asset Management. And finally, the slide that compliance wrote for me. This is our disclaimer slide, and which everyone I'm sure is familiar with. So I just at this point in time, on behalf of SIA Wealth, we'd like to wish everyone a happy holidays, Merry Christmas, and Happy Hanukkah, and we hope you all, and Happy New Year. And we hope you all have a really great holiday season. Just to note, we will be, over the holidays for the morning minutes, we will be producing the morning minutes up to the 23rd, as well as the 3 days of next week. The 24th is, the US is closed and Canada's only half a day, so likely, historically one would think that would be a fairly quiet day. And then of course Canadian markets are closed on the 28th and 29th. So we wish everyone a happy and safe holiday season, and hope you have a great day.